Good evening, class, and welcome to our advanced taxation lecture for today. My name is Chima, and today we are focusing on the topic called transfer pricing. Transfer pricing is an important topic for your examination. Now, at the end of the topic today, you will be learning the purpose of transfer pricing. You will see some of the significance of transfer pricing. You will learn something called arm's length principles. Transfer pricing and multinational companies will be discussed. You will be seeing the transfer pricing methods and evaluation of taxpayers controlled transactions. These are some of the things you stand to gain as a result of this lecture. Now, I must tell you that for this lecture, most of the time when questions come from this lecture, it's going to be purely theoretical. So I will be focusing on some of the aspects that will be very important to your examination. So not every aspect will be discussed in this video. Okay, now let's go. Transfer price is the price charged for goods or services supplied or transferred by one subunit of an organization to another subunit or member of a group or to another. So when you are selling something or when you are selling something from a member of a group to another member of a group, we don't call it sales technically. We call it transfer. It could be from a parent to a subsidiary or from a subsidiary to a parent. It could also be from one branch to another branch. Now, that is the basic meaning of transfer pricing. It is also referred to as the price at which an enterprise transfers physical goods and intangible properties or provides services to associated enterprise. So it could be associates in a group. Maybe there is a company and these people have shares in the company. They are associates. Okay, it could be parent subsidiary relationship, and whatever it is, they belong to a particular group. Something connects them together, and so when they do business, it is transfer. It's just like saying that a, a woman sells something in a shop and her husband comes to buy. It is not sales in the technical word, even though the husband pays money to her. It is simply transfer because the money is within the family. Okay, so that's it. But when you are dealing with the outside the group, then you are talking about sales. It's no longer transfer because fresh income is coming into the group, right? With particular reference to multinational companies. Now, multinational companies are companies that have presence in different nations. They have presence in different countries. Now, with particular reference to these multinational companies, transfer pricing is a mechanism used by multinationals to transfer goods and services between their related or associated companies worldwide. So it means that, let's say, a parent may be in Nigeria, and a subsidiary could be in the United States. Or it could even be that the parent is in United States, subsidiary is in Nigeria. When they do business, that means they are transferring goods and services. It could also be that the company is having a branch in Nigeria, its head office is in United States, having a branch in Nigeria, or vice versa, head office in Nigeria, branch in United States. These are multinationals. So that is the way they transfer their goods and services from one entity to the other. This external market basis, also called open market price. So external market price or open market price is one of the way to determine how much to charge for goods transferred. And this is for similar products that is being sold in the market. It is called market-based transfer price. So it means that you want to transfer, let's say you want to transfer um, your service, say you are um, lending capital to a company in the United States, you now go to the open market, how much is being regularly charged for this kind of similar transaction, and you know the rate, let's say it's 15% interest rate, and you charge that, that is market-based transfer price. Or it may be based on the cost incurred in making the product. So it means you want to transfer based on the cost. So it means you are trying to transfer the finished product, how much it costs you to produce this finished product. Then when you determine that cost, you are transferring it at that price. It's now called cost-based transfer price. It may also be determined through negotiation between subunits or members of a group that are buying and selling the product, which is called negotiated transfer price. So it is not based on the market price, it's not based on the cost price, it is now based on negotiation. The rule for transfer pricing implementation in Nigeria is governed by the income tax regulation or income tax transfer pricing regulation of 2018, which replaced that of the 2012. And it implies that although transfer pricing is not new in Nigeria, but the laws that were regulating it were first of all put together in 2012. Now, from all we've been discussing, transfer prices or transfer pricing simply refers to prices of goods, services, intangibles that are transferred between connected taxable persons. So whatever the relationship that they are, could be branch and maybe overseas branch or foreign subsidiary relationship, or it could be yeah, it could be any of these, overseas branch or foreign subsidiary, anyone, or foreign parent. They are connected in a way, or it could be associates, even if it is not a branch or subsidiary or parent. They could be associate. No one is a parent, no one is a subsidiary. Or you are doing business, you are giving them tangible goods, which is raw materials, spare parts, finished goods. You are giving them services, which is marketing, management services, training, accounting, could be intangible, trademark, patents, copyright, and so on. All of these can be transferred to connected persons. Advice on transfer price based on organization. Excuse me. Advice on transfer pricing based on OECD, Organization for Economic Cooperation and Development. These are their guidelines. The challenge for developing and transitioning countries in the development of transfer pricing is in the essence the same as for OECD countries. Now, the challenge is to protect their tax base while not creating double taxation or uncertainties that could hamper foreign direct investment and cross-border trade. So some of these terminologies could also be seen when we are taking the course base erosion and profit shifting. Okay, you still come across some of these things. Now, protecting the tax base of a country is so important because this is the base in which the country tax that multinational. While you are protecting the base, you don't want to also create double taxation in such a way that the country is being taxed in the company is being taxed in the two different places where it is getting the services and where it is receiving it. Okay, then some of these things that you may put in place may try to hamper foreign direct investment. Foreign direct investment could be that somebody is buying shares from overseas. So that means the person has an investment in a company in Nigeria. So let's say the ongoing Zenith Bank or Access Bank shares is being sold, then a company in the United States decided to key it and have maybe a 2 or 3% shares. That's a foreign direct investment. Or it could be cross-border trading, okay, import, export, and the things like that. So some of these things, the challenge is to try to um, prevent the difficulties that could happen with these kind of transactions. The adoption of transfer pricing legislation embodying the arm's length principle can be instrumental in achieving these dual objectives. So you see here that the two dual objective here mentioned is one, protect your tax base, protect your country from losing much of your tax base because when you are transferring to another country, there is a possibility of base erosion or profit shifting. So you are protecting that, and you're also not putting too much restriction on the cross-border trade. That's the double or dual objective. Now, one of the principles that OECD is using to check transfer pricing and to regulate it is by coming up with the arm's length principle. This principle is very, very much important in taxation, and you'll be hearing that a lot in our taxation class. Now, the suggested approach is based on arm's length principle, article number 9 of the OECD model, and it states that okay, we're going to see what OECD states about arm's length when we're talking about arm's length. Now, let's go further to look at some other things that we want to discuss here. The significance of transfer pricing. Transfer prices, we said before, are prices of goods that are transferred between multinationals, a company that have presence in different countries, or multinational groups whereby they're dealing with a member of their group in a different country. Of course, the thing here is um, transfer pricing can also be done locally in Nigeria, whereby you have um, different branches, different parent and subsidiary in a group, connected persons. This is still transfer pricing, but it is the thing is not as strong as when we are dealing with cross-border transaction or multinationals, whereby there's exchange between one country and the other. That is where the challenge is. So, but within the country, it is not a challenge, even though it is still transfer pricing. Now, transfer prices at which goods and services are transferred between entities are significant for both taxpayers and tax authorities. This is so because they impact on the income and expenses as well as taxable profit of related companies at different tax jurisdictions in which the enterprise and multinationals operate. So the thing here is, if it is connected persons within Nigeria, it is the same tax jurisdiction. And so the tax they are going to pay is still the same thing, even if they are different legal entities. So if a parent and a subsidiary are both in Nigeria and they deal with each other, the prices of goods that they transfer will not affect their tax rate, because when one of them is having allowable income or allowable expenses by way of transferring to the other company, that other company is calling it income. And so anything they missed or they allowed from one company is being taxed from the other company. So that's fine. But the problem here is when they are in different tax jurisdiction, their tax rates are not the same, their tax principles are not the same, and so it could impact on the companies or the multinationals' income from one jurisdiction to the other. And so transfer pricing mechanism is usually adopted by many companies to boost their head office profits, which may be at the disadvantage of subsidiaries or associated companies which operate in different countries with different tax regulations. So this is also bordering on profit shifting and base erosion. So when a company, for example, is located in a different country, let me use one of the countries let me use one of a safe haven, island of Barbados, okay, or Isle of Man. Now, if a company is registered in those islands and the head office is there, and another company is in Nigeria, another company here is in Nigeria, is being registered, and the parent company, which is the major shareholder, the parent that provides that fund, is in this island of Barbados. So that means it has a major shareholding, right? It has a major shareholding. So let's assume that 80% of it came from that country. Now, can you see now that when they are paying dividend is going out to them, and dividend, of course, will suffer withholding tax, which is very small, and this is the final tax. Now, Dividend is not even the bone of contention because it is post-tax dividend. It has suffered tax before it is escaping. Now, the thing is, it is possible that this parent company is also financing the subsidiary heavily by the way of interest. So they take out loan and they are getting interest. And interest is an allowable deduction. So you see, something is going out from Nigeria and it is treated as allowable, it is not taxed. Now, assuming now that there is a high interest rate, it means the money that is allowable will be small, will be larger and bringing your profit down. So you have a large amount of allowable escaping from Nigeria. The company's profit is now very low and they are charging a tax and the tax is very low. Now imagine if that company that is the head office does not charge tax on maybe interest interest income, or maybe they charge very little on interest income. You find out that this company's head office is their profit is being boosted, their revenue is boosted because of this plenty of income going to them. They may claim that management fees, technical fees, technical duties, and management duties is being done from the head office. And it could also be a patent right that they are selling. It could also be royalty and all that. And when they pay heavily for that, it makes the head office profits to be very, very, very robust at the disadvantage of the people who are paying it, the subsidiaries. And so the subsidiaries country will now suffer for it because they'll be charging a low tax on the remainder of the profits. Now, the legal framework for transfer pricing is Section 22 of the Companies Income Tax Act, Laws of the Federation of Nigeria 2004, the Section 17 of the Personal Income Tax Act. Then we have the Petroleum Profit Tax Act and that of the FIRS Tax Act and the Income Transfer Pricing Act regulation. So these are the legal framework for the existing transfer pricing laws. Now, let's look at the purpose of the application of transfer pricing regulation. The 2018 regulation gives effect to the provision of these are all the sections, relevant sections of the tax that as it concerns company, persons, the petroleum companies, capital gains, value added tax. So this is still talking about the legal framework. Now let's look at the objective in proper. Number one objective is to ensure that Nigeria is able to tax on an appropriate tax basis corresponding to the economic activities deployed by taxable persons in Nigeria, including their transactions and dealings with related persons. Now, this objective is one of the place I want you to pay much attention because if a question on transfer pricing is coming up, objectives of transfer pricing will not be missed. Now, the most objective here is this number one, to ensure that Nigeria as a country will be able to tax appropriately the activities carried on by taxable persons in Nigeria when they are dealing with their related parties. So it means that if you are dealing with a company in the United States, there are connected persons because they're in a group. The tax that Nigeria is taxing the multinational here in Nigeria, is it appropriate? the tax that the subsidiary is paying because it is having a parent company in the United States that provides technical service management services. Is it appropriate tax that this subsidiary is being taxed? That is the objective of the transfer price. If it is not appropriate, then appropriate steps will be taken to ensure that the tax is appropriate. So that's why sometimes when you see people filling their tax returns, they will say they will also do transfer pricing returns. So you often hear people talking about transfer pricing in their returns. And a um, the um, the tax pro max is also the major way in which companies are being taxed in Nigeria. So there's a move to make the transfer pricing regulation, the transfer pricing reporting also being done in tax pro max so that everything will be done in one sitting. Now that's regulation objective number one. Number two, the objective of transfer pricing is to provide Nigerian authorities with the tools to fight tax evasion through over or underpricing of controlled transactions between related persons. So you will learn what is called controlled transactions. Now, controlled transactions could happen because you have you're not dealing with the open market, you are dealing with connected persons. So when there are connection between two persons, there should be a level of control. It means that the person they said, he who pays the piper dictates the tune. The parent could control how much interest rate it will charge. And so that is a control transaction. So they are buying from you, they are paying far less. You are buying from them, you are paying far high. And so these are controlled transactions, and you're not using the open market method, you're not using the cost method to control or to check what is appropriate pricing to make. So assuming that you go to the market and you decide to buy certain things, and you find out that you will pay maybe let's say 1,000 naira for that, but because you have a group and the group objective must be upheld, and one of the group is also having this, and they are saying, okay, we'll be selling it for you for 5,000, and because that's a head office price, and you just can't do anything because you want to make sure the group objective is being upheld, you are that is a controlled transaction. So they want to fight tax evasion. The tax evasion will occur if these people are in different tax jurisdiction. So some of these controlled transactions are done in order to fight tax, in order to fight uh, paying of tax. So you don't want to pay tax, or you want to pay as little tax as possible through illegal means. Reduce the risk of economic double taxation. Okay, that's another. Then provide a level playing field for both multinational enterprises and independent enterprises carrying on business in Nigeria. So it means that if a multinational is in Nigeria and is doing business, the same economic activity is being done by an independent person carrying on a business in Nigeria. And so the playing field is the same. for multinationals as well as an individual. So it means whatever is being charged to the individual is the same way it's being charged to the multinational. They are enjoying the same economic climate. It's not that the multinational is enjoying a favorable climate more than the individual enterprise. So they want to ensure that everything is done in unison. Now provide taxable persons with certainty of transfer price treatment in Nigeria. So certainty of transfer price. One of the canons of taxation is that there should be certainty. Everybody should know what what is their price, that what is their tax obligation. For example, we all know that if you buy a vatable product, you are expected to pay 7.5% VAT on it. It is certain. We all know that on the 21st day of the month, that is the due date for filing of VAT and paying of VAT and that of withholding tax. This is certain. So when it comes to transfer pricing treatment in Nigeria, taxable persons should be certain of what they should expect. It should not be based on uncertainty, so that everybody could calculate and know that, okay, this is what I'm expected to do on transfer pricing. This is the price I'm supposed to pay as transfer, or this is the amount I'm supposed to buy from the other company. All right. Now, the scope of transfer pricing. The regulations shall apply to transactions between connected taxable persons. So you see, the transfer pricing regulations apply to taxable persons that are connected. What is that connection? I always say the connection is between parent and subsidiary, foreign branch, okay, and local branch. It could also be associates, right? Now, the regulation shall apply to transactions between connected taxable persons carried on in a manner not consistent with the arm's length principles. So you will learn what is arm's length principles later on, but any transactions that you are dealing with connected persons, there is a possibility that it is not done at arm's length. And some of these transactions include sale and purchase of goods and services, sales and purchase of lease of tangible assets, transfer, purchase, license of you or use of intangible assets, provision of services, borrowing or lending of money, manufacturing arrangement, and any transaction which may affect profit or loss or in any other matter incidental to or pertaining to transactions referred in the regulation. So for most of your exams, it could be sales and purchase of goods and services. It could also just be provision of services, in, for example, management services, technical services. It could also be intangible assets, let's say franchise. It could also be borrowing of money. So some of these things, when you are seeing a question that has to do with multinationals, one of the things that should be coming to your mind is transfer pricing. Now, for the purposes of applying these regulations, a permanent establishment and its head office are treated as separate entities who are connected persons. So there is a permanent establishment in Nigeria by virtue of the fact that you have a shop or a store. and or maybe you have someone who is a dependent agent, um, permanent establishment, you have a turnkey project, all other things we learned when we are talking about connected or permanent establishment. Now, this permanent establishment in Nigeria is treated as a taxable person. Then the head office where control is being given to this permanent establishment are different, are treated as different. Normally, we when we are looking at permanent establishments in the legal tax sense, we usually treat them as the same. That though you are not having a physical presence in our country, but if you have a permanent establishment, we are treating you based on the transaction done by that permanent establishment. Now that's what is supposed, that's the what holds true. But for the purposes of applying transfer pricing, we are not going to treat you as what as if your permanent establishment is as good as you. No, we are treating your permanent establishment in the in as a separate person, and we are treating you, that is the head office in another country, as a separate person who is connected to these people by based on this transfer, this transaction. Okay, and any transaction or dealing between permanent establishment and its head office or other connected persons shall be considered to be a controlled transaction. So now what one thing you should know is this. Anytime you are seeing a question in taxation where they are bringing together, they are specifying connected persons, you see language like multinationals, or you see connected persons, you see subsidiary parents, they are telling you that some of these are not, they are controlled transactions because you can easily manipulate. And because they are controlled, they will not be at arm's length. So I want you to remember when we treated capital gains tax. Now there is one question solve where someone was selling part of his I think that was the partial disposal, disposing part of his property to someone who is unknown. And because the person was dealing with an unknown person, the transaction will not be controlled. So it's going to be at arm's length. Now, because the second transaction was done with maybe his brother or sister. Now, this is connection, connected persons, relative, because they are connected by family. And that's a kind of connection by group. And so it is seen as controlled. One of them could control the other. Maybe a husband is buying from the wife or wife buying from the other. It is controlled and it may not be at arm's length. Now, let us take the meaning of arm's length. Let's see the arm's length principle. Every taxpayer is expected to comply with arm's length principle in dealing with transactions between related parties. The enterprise and multinationals are expected to be guided with the following principles. Number one, where a connected person has entered into a transaction or series of transactions to which this transfer pricing regulation apply, the person shall ensure that the taxable profit resulting from the transactions are ascertained in the manner that is consistent with the arm's length principle. So if you are dealing with connected persons, you are going to ensure that the profit you make is in line with arm's length principle. So now let me explain what this arm's length principle is. Arm's length principle is blind to relationship. Now, arm's length principle is saying that whatever profit you will make from someone who is not related to you in the open market, that is the same kind of profit we expect you to make with somebody related to you. Okay, so let's say you are selling bag in the market. You bought the bag 10,000 naira and you are selling it for 15,000 naira and your profit is 5,000 naira. So anybody who doesn't know you, you come and your last price is that is the last price. That is how far you can go. Of course, you can sell higher, but if you sell higher, of course, you'll be taxed higher. But you cannot sell lower than 15,000. That is for somebody you don't know because anywhere he goes, if he goes to any other shop, that is how much they sell it in the market. So he cannot get it cheaper anywhere. Now, imagine your family member comes. Let's say your parents is to buy this same thing from you. And you now start thinking, your parents have trained me in school, they have provided this for me, and you are now giving it to them at 11,000. Say, ah, yes, you made a 1,000 naira profit. That is not arm's length. Even if you sell it to them at 14,000, that is not arm's length because your profit has reduced. The profit that the tax authorities in Nigeria are going to take has reduced. Worst is if you sell it without making a profit. Let's say you are selling it at 9,000 naira or even at 10,000 naira, there's no profit. You have made the Nigerian government not to charge profit from your activity. And so that is no longer an arm's length principle. Now, this is, you are not giving them a loan, you are not giving them donation, you are dealing with taxable transactions, and they are taking that transactions in a way that is reducing the profit of Nigeria. That means it is not done in consistent with the arm's length principle. So they are saying here that when a taxable person is doing business with another connected taxable persons, they should ensure that the profit that comes out from that transaction should be in the manner or the same thing if it is done with someone who is not connected to them. So there's nothing like it's because I know you, or it's because you're my friend, or because you're my family member. That's why I'm giving you this price. I'm doing it because of you. No, it is no longer arm's length. A controlled transaction is at arm's length if the conditions of the transaction do not differ from the conditions that would have applied between independent persons in comparable transaction carried out under comparable circumstances. So controlled transactions are transactions between connected parties. So we want to check, are these controlled transactions at arm's length? They will be arm's length if the same conditions are applied by an independent person with another person under the same circumstance. So they will look at under what circumstance are you dealing with your connected person. Now the profit that result from that transaction in that circumstance, if an independent person who is not connected to your group were to deal with that person, is it the same thing that will be charged? So it means that, let's say for example, I am charging for my lecture fees, I charge, let's say, 50,000 naira for the diet, and somebody who is related to me or related to my connected party, let's say, is coming from FCA to come to deal with me, I I now decide to charge the person lower than that because it is a controlled or connected person. So they will check under the same circumstance if a different person who doesn't know her were to do this same transaction, will they charge the same amount or will they charge higher? That is controlled transactions the arm's length principle is being used to monitor control transactions. Now, where a connected person fails to comply with the provisions of this regulation, the service shall make amendments where necessary in order to bring the taxable profit resulting from the transaction in conformity with the arm's length principle. So it means that, let's say that I'm supposed to charge 50,000 naira for the class, and let's say my family member decides to enter the class and I charge the person 20,000 naira or nothing at all. The tax authority will say, okay, because it is not consistent with the arm's length principle, they are going to make assumption that you have charged this person 50,000 naira, and the profit, the deemed profit from that transaction will be charged accordingly. So it means that if you are reducing your profit because of controlled transactions that are not at arm's length, the tax authority will make necessary adjustments to ensure that this is in conformity with arm's length principle. So you see what the arm's length principle is saying? Do unto connected parties what you will do to non-connected parties. That is just the arm's length principle. And so most times when you answer question in taxation, be at the lookout for arm's length principles. Use it in your discussion. Transfer pricing and multinationals. Multinational corporations, which are also known as multinational companies, are corporate organizations that own or control production of goods or services in two or more countries other than their home country. Put differently, such companies have offices, factories in different countries, and usually have a centralized head office where they coordinate overall management. Now, in Nigeria, multinational companies such as ExxonMobil, Total, Chevron, Ajib Shell, Petroleum Development Company, and so on now dominate the oil sector. So you see now they are multinationals dominating the oil sectors in Nigeria. That means they have an office in Nigeria, but their control is not in Nigeria. Other sectors of the Nigerian economy with multinational companies in the manufacturing areas include Cadbury, Guinness, PZ, Nestle, Unilever, Procter and Gamble, Glass, GlaxoSmithKline, Reckitt, and so on. We have MTN, we have Airtel Mobile, Nine Mobile. These are some of the things here that are being classified as someone is saying, I love this pattern of explaining arm's length principle. Due to connected persons, what do to unconnected person? Okay, due to connected persons, what you will do to unconnected person. Thank you. So that's the principle. Due to connected persons, what you would do to unconnected persons. So we are looking at these multinational companies in Nigeria, present in Nigeria. Some of them have left as a result of unfavorable taxation climate, like the GlaxoSmithKline. They have left. So you see here, one of the dual objective of ED is to protect Nigerian tax base. So, but they don't want to also make the company have unfavorable climate in Nigeria. But because of this unfavorable climate in Nigeria, so to speak, some of these companies have left, while some are still there. We have the likes of MTN, Airtel, Nine Mobiles. They are all Nigerian multinational companies in Nigeria. So, different prices of goods and services at purchase cost. Now look at it now. Different pricing of goods and services at purchase cost. In any multinational group, a member of the group in one country may supply goods or services to another member in another country. I'll be using an example here. So um, let's say I'll be using FCA and Go Getter because they are connected persons. Let me use it that way. Now, let's say Go Getter is in the United States and FCA is in Nigeria. So FCA may supply goods to Go Getter. Or it could also be that GoGetter is providing management services for FCA. It could be that this lecture that you are having here is provided from United States and it's a kind of uh, management services done for FCA to the students. It could be, you may not know. And now this is different companies or different countries exchanging goods and services between two countries. By implication, the prices often charged creates revenue for the company that is selling. So it means that if FCA is selling goods to Go Getter, it is representing sales revenue. If Go Getter is the one receiving the service, it represents cost of purchase. If Go Getter is the one providing this management service and they are being paid, it means for Go Getter it is a revenue. For FCA who is paying for that service, it is cost of purchase. That is one thing you should know. And now, because they're in different countries, it provides a platform for tax avoidance. When companies operate under different jurisdiction but belong to one group, they may decide, depending on what they want to achieve, to underprice or overprice their intergroup transaction. So it could be that they want one company to get so much profit and so they overprice. So it means that, let's say Go Getter is the one providing technical service and they want Go Getter to have much profit. They overprice their management fee so that when they are paying it to Go Getter is having far more than it should. And why would that be a good thing? It is because maybe Go Getter is in one of these islands, Solomon Island, Isle of Man, Isle of Barbados, and their tax rate is very small. And so the more the profit is going there, the more, the less too they're also paying. So if they have kept the profit in Nigeria, they would have been, paying more taxes than it would have been if it is going there. So that is one of the things they may want to achieve. They could also say that, okay, they want to underprice. They want to underprice. So it means that if Go Getter is buying goods from FCA and it's supposed to be 1 million naira, if it is 1 million naira that is being sold to FCA, it means that is going to be revenue to FCA. But because maybe FCA, that is going to be revenue for FCA, right? But because FCA will be taxed on the revenue, they will be taxed on profits based on that revenue, or they want to hit a particular threshold, they may underprice. After all, it's going to our connected persons. We are brothers. They will underprice. So instead of 1 million, they will just say this is 600,000. And Go Getter is getting it at 600,000. Whereas in the open market, it's 1 million. And so they have underpriced. And the profit that FCA should be having which will also impact on their tax, will be reduced. So this is tax avoidance. Now, this is different from tax evasion. They're still going to pay tax, but they are doing tax avoidance by overpricing and underpricing. The tax implication of the foregoing is that multinational transfer pricing can provide the avenue for this avoidance. The major thing is they don't want to pay tax, or they don't want to pay more tax than they should. Now let's look at this one again, custom duties and tariff manipulation. Custom duties paid on imports and exports are usually based on transfer price. So if the transfer prices on imports are low, the import duty will be low. So you hear now that Nigeria is charging import duty, and if FCA is selling goods to Nigeria, and if GoGeta is selling goods to FCA based in Nigeria and FCA is importing, if GoGeta decide to underprice the goods it ships to FCA, it means that the custom duties will be low and the tax to Nigeria by way of custom duty will be low. So can you now get something here? Now let's look at the point here where Nigeria is the one that is being targeted. Now, as I said, Go Getter is in another country, let's say Solomon Island. FCA, its connected party, is in Nigeria. If FCA is importing any tangible goods from Go Getter, okay, so they will arrange it in such a way that Go Getter will be the one to sell and FCA will buy and import. They may want to underprice tangible goods that will be cleared at the port or borders, so that the custom duty will be low because it's based on transfer price. But if you look at management service that they are also now selling to FCA from the same abroad, because it's not going to go through the ports, it's not going to be cleared, it is just going to go straight, they may want to overprice so that much money will leave FCA Nigeria to Go Getter and it will not go through the ports. Now look at another one here, dividends manipulation. An instance of dividend manipulation is when country A restricts an amount that can be paid as dividends to another country, which is country B. So now let's say Go Getter is having a share in FCA. Go Getter is in country B, FCA is in country A, which is Nigeria. And now Nigeria restrict the amount of dividends that can be paid to B. Okay? The company in B may decide to overprice its goods and services that is transferred to A. So the implication is that more funds will be remitted to the other country in country B without violating that restriction dividend. So we are buying shares in FCA in Nigeria, and you now say that you cannot pay dividends of more than 10 million to outside country. And now, okay, you cannot pay more than 10 million, and I'm supposed to have 15 million as my dividend. But when you want to pay, you will not pay me 10 million. Okay, no problem. You can't get the other 5 million. I will go and overcharge you in certain things so that one way or the other, that 5 million you are paying will come back to me, or even more than that. So that is dividend manipulation. Then, of course, we talk about excessive charges, which is usually done through royalties, royalties or patent rights. You know, all these franchises, they will also come use that to do excessive charges. Most of these things are done with intangibles. Intangibles are not physical things that can be cleared at the border. They are done on intangibles. So the foreign subsidiary will be paid high. Let's say the head office is in a tax haven, and I told you of example of a tax haven, Isle of Man, Solomon Island. They are now charging excessive patent rights to Nigeria, and Nigeria will be paying through their nose, and it's going to be allowable, but the people receiving it are enjoying favorable tax climate. Now, where the head office or the multinational or a member of the group incurs expenses which are for the benefit of all the members, the allocation of the joint cost to members of the group will certainly affect their profits and taxes. So it means that the management have made payments or made expenses that are supposed to be shared. It normally happens in companies that have branches. Head office will just say, okay, they will make a particular payment or particular expenses. If you want to buy, if you want to buy goods and you want to, have economic of scales, so to speak. So you buy so much large quantity and get certain advantages. You may want to pull resources from all your groups or branches. So it means that the centralized headquarter is the one making that purchase. And so when they now make that purchase, they now share it among the groups and branches, and they get to pay them. So when the head office has incurred expenses that is for the benefit of everybody in the group, and they now share it to the group, they may use a sharing ratio that may be unfavorable. They could decide that they will share it equally, and somebody who is having, let's say for example, you are living in a compound where the landlord is the one who pays the NEPA bill, and everybody is asked to pay equal. Maybe there are 10 tenants, they share it equally into 10 equal parts. The person who is using air condition and using hot plates, having 3-bedroom flat, is paying the same amount with somebody who is living in one room that has only fan without television. So you see, it will affect how much they are going to pay. So look at it now in the group. Somebody is not making that much sales, making that much profit. It's going to affect his revenue because that's a cost on him. It's going to affect his tax. So it is the practice of Nigerian authorities to ensure that transactions between connected persons or related parties are not okay, not made okay. It is the practice of tax authorities in Nigeria to ensure that transactions between connected persons or related parties are not made at arm's length to reduce the tax liability. That is what is in practice when these excessive charges are being made. So they want to make sure it is not done at arm's length so that one party will be paying more. In short, one party will have favorable results and the other will have unfavorable results. Now, the thing is that it affects Nigerian tax authority. Then we have multinationals play a key role in the global economy. Yes, multinationals play a key role. Look at Shell, look at MTN, look at Airtel. Without these multinationals coming into Nigeria, we will not be having good telecommunication provision, our oil economy will not be booming that much. So they play a role in the global economy wherever they have presence. So the government need to ensure that taxable profit from these multinationals are not artificially shifted out from Nigerian jurisdiction. This is what they call profit shifting, and goes to the reporting country, which is base erosion. No worry, when we get to base erosion and profit shifting, you'll be seeing how this profit shifting and base erosion is being done. But for the purpose of this class, we're going to be mentioning that. So government need to ensure that the taxable profit is not eroded or shifted from where it is being made, the base country to the reporting country. All right, so according to the OECD, it is advisable that taxpayers should remit the risk of economic double taxation that may result from disputes between two countries on the determination of arm's length in their cross-border transaction with associated enterprise. So they don't want you to be taxing two two countries taxing one income, like we learned in the last class, where we now have double taxation treaties and all that. So OECD want to reduce or limit the risk of this double taxation occurring, especially with member nations. Now let's come to another thing that you will need to know for this topic of transfer pricing. One of them said before is um, the objectives and the scope. Now, this is the methods, transfer pricing methods, and evaluation of taxpayers control transaction. This is another um, point you will need to pay attention to. Now, determination of appropriate market prices of product and services, which will reflect arm's length transaction, is usually difficult due to unavailability of similar products or services which can be compared in the open market. So it means that if you are transferring from one country to another a particular goods and service, we said that for arm's length to be determined, I said before, do unto connected parties what you would do to independent or unconnected parties. How will they know that your transaction with your connected parties at arm's length? They will want to look at an independent enterprise. How will that independent enterprise relate with the open market or relate with somebody who he does not know? So in similar situation, so if they cannot find similar situation or they cannot find similar product or services in the open market, then it will be difficult to determine if arm's length principles have been followed in that controlled environment. Now, even though tax legislations in Nigeria have not dealt specifically with the subject of transfer pricing, the Tax Act empowers the tax authority to set aside the charges that you made to similar party transaction if they think it is not at arm's length. I want to refer to the CGT we did before, where we saw somebody selling disposing his part of his land to his brother, and is charging him at a price lower than what is in the market. And the tax authorities set aside the price he gave to his brother. Even though there is documentation, there is receipt, they set aside that price and they are using what is in the market, because that reflects arm's length. So if the tax authority in Nigeria, even though they cannot see similar product and all that, if they discern that this could be not at arm's length, they will set aside the price you use and impose what they think is the arm's length price. Now, the following transfer pricing methods can be used by the tax authorities to determine whether the results of a transaction are consistent with the arm's length principles. There are about 5 of them here. You may be asked to name them and explain what each of them does. And this your exam, you will not be asked to carry out transfer pricing, but you'll be asked to examine it in the light of this method. It is when you are in practice that, of course, you will have to use these methods now to evaluate transactions. The first one is the COP method, comparable uncontrolled price. We'll talk about it. The resale price method, the cost plus method, the transactional net margin method, transactional profit split method. Now let's look at them one by one. The two, there are two broad divisions we want to classify them. One of them is transactional method. So number one, two, three are transactional method because you see here, price is mentioned. All of them has to do with pricing. The COP method has a price. Resale price method is a price. Cost plus method. Cost plus is thinking about the profit. Now the other one is profit, transactional profit method. So net margin is still a profit, profit split is still a method. So we can either use traditional transaction method or profit method. All right. Now in each method mentioned above, the most appropriate transfer pricing method shall be used, taking into consideration one, the respective strength and weakness of the transfer pricing method in the circumstance, and two, the appropriateness of a transfer pricing method having regard to the nature of the control transaction determined. So we are going to be looking at what are the functions performed, what are the assets employed, what are the risks assumed by each party. This will enable us to know which of the method is most appropriate. So if you are ready, let's look at the methods. Now the first one is the COP method, comparable uncontrolled price method. COP. Now comparable, so there's going to be compare. Uncontrolled price. So you see here, prices that are not controlled but are compared. That's the point. Comparable uncontrolled price method compares the prices charged for transactions between associated parties with prices charged for similar transaction between independent or unrelated entities in comparable circumstances. So it means here that when transactions is going on between associated parties, it is controlled pricing. But now when it is going on between independent, unrelated parties, it is uncontrolled pricing. So you see we have achieved uncontrolled pricing. Now, we are now comparing what happens between related parties in controlled setting with what happens with unrelated parties in uncontrolled market situation. When we are comparing two things, you will find difference, isn't it? Any difference between the prices is an indication that the transactions between the related parties are not arm's length. So any difference in the pricing shows that it is not at arm's length. Let's look at an example here. Bella Limited are members of the same group with Ben Limited. So we have Ben Limited, Bella Limited. Now, if Ben Limited sells a particular product to independent parties That means this product, let's say it is a spare part. He sells that spare part to people who are not connected to him. And he sells that same part to Bella, a member of his group, under similar circumstances. So what happens here is that the prices charged to Bella, the prices charged for Ben's sales to Bella will be compared to what it is selling to independent parties. So it means that if I'm selling to outside market at, let's say, 10,000 naira, and when it comes to my related party, I'm selling 8,000. And I find out that there is a difference in price, but they are the same circumstances. Then there is no arm's length transaction. Now, this comparison is called internal comparison. Why is it called internal? Because who Ben's price with his associated party is compared with still Ben's price with the outside world. That's internal. Now, external would be if another independent party sells similar product to another independent party. So they are going to compare the price sold by this independent party to the outside world, and they will use it to check Ben's price to Bella. So that's external. So they are bringing external parties transactions comparison in the same situation to that of the group sales to each other, and that is external. And the tax authority may reject the prices between the associated enterprise and will adopt that between the independent enterprises for tax purpose. So you see here, when they find out that you are selling differently, whether you are selling too high or too low, they will not say because you are selling too high to your related party, they will reject it and take the price that they have compared either internally or externally. Internal comparison is your own price with your related party on the one hand compared with your own price with the outside world. If there's a difference, they will take that of the internal, the independent, that's what they call it, independent comparable controlled prices, comparable uncontrolled price. So they are going to take the uncontrolled price. The uncontrolled price is the price that independent you charge to the outside world or independent person charge to the outside world. That's the uncontrolled price. When they now compare it with controlled price, they go in favor of the uncontrolled price. So that's what they call comparable uncontrolled price. All right. On the one hand, when applying the COP method, it is important to note that prices for the same product may differ, not necessarily because of being sold to associated or independent enterprises, but because the product is not sold under similar terms and circumstances in comparable quantities and markets. So it is usual to make reasonable comparable adjustments for such difference. So you are looking at the prices, and as you're looking at the prices, you'll be looking at it that what are the circumstances under which it is being sold, not just looking at how much it is being sold. What are the circumstances? Even though they are similar products, but what are the circumstance? It could also be that they are the same kind of product, but one of them has more quality than the other. Okay, so they are not like similar, so to speak. Okay, But the major thing here is the similar product is sold in the same circumstance. So it means you have to create or observe it in the same circumstance. Otherwise, you need to make reasonable adjustments. So it means that if you cannot get the same circumstance, you will now make some assumption that, okay, let's say for example, somebody is buying um, something during peak period. Somebody is buying something during off-peak period. Okay, during off-peak period. Normally when you enter bus to go to anywhere at peak period, the prices are different, right? And you go to off-peak period, the prices are not different. It's the same with peak period. So these are like similar, different circumstances. You need to make some reasonable adjustment. Okay, if they charge it in this off-peak period, and that is how you bought it, what is the assumption you could make if it was bought in this circumstance? So that's the way I would want to use the example to give here. So when you're using the cup method, the prices is involved, the circumstance is also involved here. Now let's go to the ROPM, resale price method. So when you say resale price, it means you must have bought it and you are now reselling it. How much are you selling it? Resale price method starts with the determination of the resale price to an independent enterprise of a product you purchase from an associated uh, connected party, and then a gross profit is deducted. Okay, so what they mean here is this: somebody is selling something to an independent enterprise. Now, this same thing you are selling to the independent enterprise, how did you get it? You got it from your associated party. Okay, so it means that the resale price starts counting from how much price did you sell it? Okay, in the first one we did before, we are looking at how much did you sell to related party and how much did you sell to unrelated party. We are now looking at the difference. But in this method here, you have bought now from your related party. Now they are using the method, okay, you bought from related party. How much did you sell to the outside world, right? They now deduct it from your cost and you have a gross profit margin from this resale price. So that's how, okay, now let's look at this example here. Goodwill and Tent, they are related parties. Now, God will transfer goods to Tent because these are related parties. This is a controlled transaction. And then Tent bought these goods and sold to independent parties. Now, under the resale price method, the arm's length price of the goods acquired by Tent in a non-arm length transaction is determined by reducing the price realized on the sales. Okay, so it means that you bought these goods not at arm's length, right? Let's say I bought these goods instead of buying it at 10,000 and I'm now buying it at 8,000. Fine. Now, you are now selling it to the outside market. This normally, if somebody buys this good 10,000 naira and is selling it for 15,000, and that is how it is being sold in the market. You are now buying this good at 7,000 naira or 8,000, and you are selling at 15,000. It's fine, though. You have sold it, you have resold it at arm's length. Fine, you sold it the way you sell for every market because that's what the market is saying. But how did you acquire it? Did you acquire it at arm's length also? So it means that even though you sold at the same price in the market, your profit margin has increased because you bought it low and sold the same way in the market. Now, with the resale price, they will reduce your profit margin so that your appropriate profit margin will be obtained by you. So it means that um, they said the arm's length price of the product acquired by tenant in an on in a non-arm's length transaction is determined by reducing the price realized on the sale of the product by tenants limited to the independent parties by an appropriate gross profit margin. So it means that what they will do here is this. Let's do something here. Let me activate my calculator now. You normally buy goods at 10,000 naira and you sold it for 15,000 naira at 15,000 naira. Now, 5,000 naira is your profit, right? What is your gross profit margin? 5,000 divided by 15,000. That should be, okay, let me use something that will not have this point. Let me use 12,000 minus 10,000. So 2,000 is the profit. Now divided by the 12,000 you sold. Now that's, why am I getting things like this? Let me try something else again. Let's say 6,000. No, let me not use 6,000. Let me say 5,000. Yeah, let me still use 5,000 divided by 15,000. No problem. Let's use the first example. This is your gross profit margin, right? That's fine. Now, your gross profit margin is this. So what happens if you went to buy goods at 8,000 naira? 8,000 naira, and you are selling it at 15,000. Your gross profit is 7. 7 divided by 15. You are making, gross profit margin is higher. But now, they look at it that the gross profit margin for this transaction is supposed to be 0.33333. And so, what would have happened is this. If you had used arm's length transaction, you should not be getting 0.43466666. You should be getting 0.33333. So how will they achieve it? They will simply achieve it by saying 0. Okay, no, what you 0. What's the profit you made? What is the selling price you bought? You sold it at 15,000. You sold it at 15,000. They'll simply divide 15,000 by 0. Okay, the 0.333. Okay, it's not divide, it's multiply. 15,000 times 0.33333. I'm doing something wrong here. I did 15,000 times 0.33333. So your profit is supposed to be 5,000 naira and not 7,000 naira. And so what they will do is from the sales that you've made, they will deduct 5,000 naira from it. So that means the transfer arm's length price should have been 10,000 and not 8. And so they have deducted from your selling price because of the gross profit that they know that should be used. So the reference here is the gross profit margin. So they use your selling price, they look at what is the gross profit margin that should come out from this transaction. And when they got the gross profit margin, they use it to determine what your profit should be versus the profit that you made. So they will use the profit that should be and deduct it from how much is sold to know what the cost should have been. And then I check your book, the cost was lower. And they say, okay, we are going to set aside that lower cost. We will assume you bought it at the arm's length price. So that's the resale. So the difference between the resale and the cup is that you look at, you didn't buy it from associated companies. You bought the goods arm's length, but now you are selling to associate and selling to outside. They will look at how much you are selling, the sales value, and they will compare. Resale method, you have already bought it in from connected parties, and now you are selling it to either outside world or to another connected party. No, you are selling it to the outside world. They will look at it. If you have sold it at non-arm's length, they will use the gross profit in it from the price that you sold it, the resale price, to determine how much should have been the cost. And so that is the resale price. Now let's look at the cost plus method. Cost plus now means you've made a cost and you are adding a markup. Now markup is relation to cost. Margin is in relation to sales. I thought I mentioned it the time we were doing some of these things, okay? Cost plus relates to profit to the cost of sales. So it starts with the determination of the cost incurred by the supplier in a controlled transaction. Then an appropriate markup will be added to arrive at the correct price. So it means that you want to transfer something to your connected party, and you know you're not going to transfer the correct price. They want to determine using how much did it cost you. Now look at this example here. D Limited and G Limited are related party. Now D Limited is transferring 10,000 units of a product to G Limited at 700 naira per unit. Okay, this is the price it wants to transfer. The direct cost incurred by D to produce this thing here is 400 naira per unit. Now, let me use my calculator. 400 naira per unit. So that's the price, the cost. Now, the arm's length markup earned by companies producing and selling this to related party is 45%. So this is 400 naira, and you need to mark up with 45%. How do you mark up? You simply multiply it by 1 point the markup fraction. So 1.45. So the 1 is 100%, the markup is the 45 on the cost. it means you are supposed to charge 580, 580, which is the 580. Now we are charging 700. So we are transferring it at 700. So the tax authority will look at the 580 and they will accept it. That is the transfer price instead of 700 that you are using because of the cost plus method. Because you are saying that what was the cost plus? What is the markup when you use 700? If you use 700, 700 minus 400, that would be like 300. So what is the markup percentage? 300 divided by 400 multiplied by 100. So it means you are charging 75% instead of 45%. So they will set aside your 75% markup and they will use the 45 based on the cost. So you see, they are using different method. So it depends on the situation you have. If you are transferring to arms, if you are transferring to related party, they want to use at cost plus. If you are the one making the cost, they want to also use comparable method. Now look at profit splitting. Now profit splitting starts with the determination of the combined profit that arise from a business transaction in which associated enterprises are engaged. This profit is shared among associated enterprises in a manner that reflects the division of profit that would have been expected among independent enterprise. So you see here now that they are doing combined profit. They do a particular project. They do a particular project and the combined profit or loss is allocated based on the associated proportion to the relevant contribution. Let's say, for example, a company is doing a plane, aeroplane, or aircraft, or ship. So doing an aircraft is just one. So, but different countries play a role. So maybe a spare part was gotten from Nigeria, a technical support was gotten from Nigeria, another country brought something into the table, another of their member country brought something into the table, and all these costs were brought in. They now have a cost, they now sold the aircraft, and they made a profit. How will they share the profit? Of course, it's not going to be 50-50. They are going to look at what was your role in this project? What was your contribution? What risk did you assume? What asset did you contribute? So they will use that. All these things have weight. So your capital contribution, the role you played, the risk you assumed, they all have weight such that when they make all the necessary multiplications to get an overall weight for that company or for that country, they will use it to get all the companies or the related parties, they will bring all their weights together and they will use that weighted um, weighted fraction in order to know which profit they will allocate to each company or each related party so that the appropriate taxes can be done. You don't expect somebody who provide 90% of the the capital, even though it doesn't provide any other technical services, to get the same weight with somebody who or he didn't make any capital contribution, but he only gave technical contribution. Maybe he gave 80%, or somebody who just brought in a spare part and that's all. So you see the risk assumed, the contribution you made, the capital contributed, all of this take a role in determining how the profit will be splitted. Then we have the traditional net margin method. Now, this net margin method begins with determining the net profit. Now, this is different from the resale price, where we start from the price and we now got the gross profit margin. Now, this is net profit. Now, we have the net profit margin that an enterprise earns from transactions with an associated enterprise, and is now compared with the net profit from comparable transactions with independent country and enterprise. Now, this is like the COP method, but in the COP method, it's the sales value that is being compared. But here, it is the net profit that is being compared. A suitable net margin may be established by reference to the net margin that the enterprise earns in comparable with the independent enterprise, either internal comparability or external comparability. The transactional net method is applied in similar method also to the cost plus and resale price, whereby when you get the appropriate net margin, you either use it to either reduce or increase the cost or the profit that should be gotten. But the only similarity this has with the COP method is that the comparison is made on net profit as against the sales value. All right, so this is intra-group services. Now, intra-group is a service is charged between a taxpayer and connected persons, shall be consistent with the arm's length principle, where one, it is charged for a service that it usually rendered. So if you are charging for a service that you usually rendered, it will be seen as arm's length. Two, the services provided or when provided was expected to provide the recipient with economic or commercial value to enhance this commercial position. So of course, you have to give an appropriate price to enhance your commercial position. It is charged for a service that an independent person in comparable circumstances would have paid for if performed by an independent person, all right? Or would have performed in-house for itself. Then fourthly, its amounts correspond to that which would have been agreed between independent persons for comparable services in comparable situations or circumstances. So all these things here are still talking about what we've discussed before. So all these still have a way of, it's a way of reminding, it's a way of emphasis that arm's length is very, very important. A service charge made to a person shall not be consistent with arm's length where it is made by a connected person solely because of the shareholder's ownership interest in another member of the group, including any of the following costs incurred or services undertaken. One, cost or activities relating to judicial structure of a parent company of the first mentioned person, so that meetings of shareholders of the parent, issuing of shares. So all these things are not seen as arm's length. I will not want to bother much about this. You can read them all because these usually do not come out in the exams, and You may also want to read that so that I will not be repeating some of these things one at a time. Intangibles. The determination of arm's length conditions for control transactions involving the exploitation of an intangible asset such as um, franchise and all that. That when you are taking account of these intangibles, some of the functions, some of the consideration you need to consider are the following. One, functions performed by the person. Two, management and control of those functions. Three, contributions by persons of assets, including financial assets, management and control regarding contribution of assets, risk performed, management and control of those risks. These are the things I've also said when we're doing the profit split method. I also mentioned these intangibles. So let's not go down because some of these things are still repetition. So suffice it to say that the most important things that comes out in the exams have been discussed. So the most important things here is the scope, the purpose, and the methods. These are the three main important things I want you to take note of in this topic. All other things here are just for completion of the topic. Not all are being tested in the exams. So the ones that are being tested in the exams are the ones that have been discussed. Most of these things here are for to complete the knowledge for those who will be practicing it. So look at connected persons, the meaning of connected persons. I've mentioned that before. So all these are connected persons. And we talked about arm's length principle. We've talked about the meaning of arm's length, the meaning of permanent establishment. Now let's talk about thin capitalization. Thin capitalization. Now, whenever I talk about thin capitalization, I look at this word thin. Thin is the opposite of fat, right? Capitalization talks about capital structure. So when capital structure is now thin, not fat. So let's look at what it says here. When a company is financed with much greater proportion of debt than equity, it is said to be thinly capitalized. So it means that in a financial structure, you have equity and debt. Now, there should be an appropriate balance between equity and debt. For example, if a company finances 50% of its capital structure with equity, 50% of debt, that means they are both equally capitalized. Now, when the company decides to use another company, similar company, use 60 equity, no, 60 equity, yes, 30 debt, the equity is taking a higher toll. Another one could say, I'll reverse it, 40 equity, 60 debt. You see, the equity is getting slimmer or thinner. You will get to the situation whereby 10% will be equity and 90% debt. It could happen. You've registered a company, maybe the company is registered with 1 million naira shares, right? 1 million naira shares, and maybe there was no debt. Your company is 100% equity geared, equity driven. Now you now begin to collect debentures, bonds, long-term loan, and you now find that you took 1 million naira loan. Now your capital structure is now 1 million naira equity, 1 million naira debt, equally geared. You increase it 2 million naira. So you see your company is now 75% debt, 50% equity, things like that. So you collect debt and debt. So your company is financed more on debt than in equity. This is thin capitalization. What is the problem with thin capitalization, you may want to ask? In financial accounting, it is said that the company is highly geared. So when we do gearing ratio, it means they are putting debt over equity or debt over the total structure of the capital. So if it is more than 50% debt, then it is highly geared. The tax authority will be disturbed when there is excessive um, um, when there's excessive loan capitalization or debt capitalization as against equity, because one, interest, which is the payment for debt capitalization, will be high when debt is increasing. Now, if this debt is being paid to a foreign entity, if this interest is being paid to a foreign entity at non-commercial rates, and these parties are connected parties, it means that high debt leads to high interest rates. High debt leads to high interest rates. Now, what happens if your interest rate is high? Interest is an allowable deduction for tax purpose, meaning that the interest would have been deducted first before you now charge tax. So if this interest is being paid to a foreign company, it means a large portion of the profits that would have been taxed has been deducted and shifted without taxing it to these companies. And so it now reduces the profit that will now be available for tax. Unlike equity, where dividend is given out after tax. So tax has been done, and so the after the it's after tax profit that you now share. So some people will now prefer to use debt instead of capital, equity capital, because they want their interest, the profit, to escape tax. So one of the reasons why dividend income is seen as frank investment income, in the sense that it has been taxed before it is shared. But interest has not been has not been taxed before it was shared. So a large portion is escaping as interest. Only withholding tax is being charged. Now, to circumvent the negative effects of thin capitalization, some countries place a limit on the debt to equity ratio. So it means that if your company, if the country say your debt equity ratio should not be more than 75%. 75%. So the equity, okay, they might say 3:1. 3:1, meaning that your debt must not be 3 times more than your equity. Your debt cannot be 3 times more than your equity. That's another. So if your debt now is 4 or 5 times higher than your equity, what they will do is they will look at your equity, multiply it by 3. This is the limit of the debt that will be allowed. The interest, now they will now look at, this is the limit of the debt you can allow. The interest on that allowable limit will go untaxed as allowable deduction. The rest will be added back for taxing purposes. So some countries will say, okay, we want that is how we will do it, while others disallow interest deduction above a certain level. So they might not put a cap on debt ratio. They might say, okay, let's say interest allowable should not be more than 50 million. Now you now have interest, and your interest is about 60 million. 50 million will go as allowable. The remaining 10 million will be added back to be taxed. So it's either you use a percentage or a ratio to say, okay, this is the debt equity ratio that is allowed, or this is the threshold of the debt that can go allowed. All right. So we have arm's length comparability factors in transfer pricing. Okay, so you need to read that up because it's still repeating some of the things that we have talked about. So, what are the take homes for today's class? What are the take homes for today's class? One, we've seen transfer pricing is important because multinationals exist, and multinationals impact on the economy of a nation, but you cannot help but find controlled transactions between these multinationals. And so transfer pricing regulations are important to check tax avoidance of these multinationals. And now we learned about the purpose, the scope of these OECD's transfer pricing regulation. We also saw 5 different methods. The COP method, which we said is checking either internally or externally, comparing the sales price for associated party with independent party. We looked at the resale price method, where we start with the price you sold for goods you collected from connected party, and we now get a profit margin which is either being deducted or reduced, or which is used to find the appropriate cost that should have been transferred. We also look at the cost plus method, which looked at how much did it cost you to make these goods? What is the appropriate markup? And when you put the appropriate markup, this is the amount you are expected to transfer. And now check how much you now transfer. Oh, so that means they will set aside that price and use the cost plus method. And profit split method, we looked at what role did you perform in this project, what was your risk, what was your contribution, how did you contribute in a way that's getting the appropriate portion of your profit that should go to you and be taxed. Then we have the transactional net margin method. So we have the net margin that you are getting from the sales to a connected party with sales from a non-connected party. So the appropriate adjustment is being made. We learned about what is thin capitalization, and we saw why it is very, very, very harmful for a company or a country to allow thin capitalization. And so we saw the safeguards that is used in ensuring that thin capitalization is reduced. So far, so good. We have come to the end of this topic. This is a very important topic that I want you to go again and play back this video, go to this topic again and read it up, because if it comes out, most of the things I've said here are the things that will be asked of you in the exam. Okay, so look out for appropriate past questions and see how this can aid you in answering some of the questions to see what is being tested in the exams so that you can prepare adequately. So in our next class, we shall be looking at a related topic to this, which should be the base erosion and profit shifting. We'll be looking at that so that we'll get a very good understanding of some of these things that we've said today. So thank you so much for the time and for coming into the class today. We hope to see you in our next class and to have an enjoyable time with you. Any question you have, please ask me via WhatsApp or via email. So once again, I say thank you and do have a lovely day.